Okay, so let's start this off. We'll just go down the line. I think I'll ask each of you kind of the initial question. Just introduce yourself and, give us a couple of sentences about your fund's focus, sector, stage, things like that. I think that'll be a great way to start the house.
Share the other one.
Okay, great. Nicole Naidoo, partner at Wholesale Partners in San Francisco. We are a $5 to $30 million checks into mostly Series A rounds. We'll leave the rounds will be the majority of the rounds. Yeah, that's me. Oh, B2B focus. All B2B tech, kind of middle of the infrastructure where you'll go to deeply go to cold ones as well.
Thanks all. Ruiz. I'm the co-founder and general partner at Infinity Ventures. Prior to Infinity, me and my two other partners were at PayPal, leading the corporate venture arm there for a number of years. We are sector specialists. We invest across two verticals. One is in fintech, another is commerce and infrastructure, and typically lead rounds across Pre-Seed, Seed, and Series A.
Hi everyone, Eugene. I'm a partner at Construct. We're a venture firm based in DC. We invest in what we call the transformation of foundational industries, so things like manufacturing, supply chain, logistics, real world seed verticals. Our initial check size has been 2 to 10 million.
How big does the company need to be at exit in order to make sense for your fund?
So the simple venture math that everyone here has heard and all the VCs think about is that, every investment for it to be a real winner needs to return the entire fund. So we're investing in Fund 3, which is a $300 billion vehicle. We write Series A checks and we only need rounds. And we target an ownership position, I would say, if not 10 to 15%. It's simple arithmetic, unfortunately, but that's how we back into it. So now the influx value of, say, $4 to $5 to $10.
Very similar kind of venture math. I'd say like for us, it's half the fund. So the fund is kind of like the bonds, like half the fund is the threshold for investing at 185 in our fund. And so we'll be targeting 10 to 50% ownership at point of entry with submission, call it 8% roughly at exit. And so call it a 102 to 2 billion is kind of the range of what we're looking for on a minimum, like below side for an exit.
We probably got a little bit of a different approach and just $275 million fund, very few investments. So this fund will have 12 to 15 investments. And so maybe taking a little bit less risk, losing money less, but maybe not as big of swings at first. Unique fund exits that are $150 million. We're underwriting to 5. So maybe we can do from the get-go 5x our money, and in an upside situation, there's opportunity around way past that is kind of how we think about it. But every step of the way, once we're re-underwriting, there'll be situations where if you don't pay 20x, it'll be like more schmucks, and 2 to 3x because the market changed or whatnot. That's a successful outcome. From the get-go, 5x. That means there are outcomes that 150, 200 million becomes something attractive. Usually in those cases, the companies aren't raising a lot of money after us, so you don't have to deal with that dilution. And then there are other companies, but it's all in context of how they capitalizing.
So this one is going to be for Nicole and Eugene. Onto the main top ranges and projections, and we're talking about founders that are Series A. It almost seems like a crazy exercise to try to predict like 2, 3, 4, 5 years out, right? There's so many variables, microeconomics, a million things. So what are the virtues of going through the process of building a projection versus like the other way of looking at it? So let's just look at the market opportunity and kind of stack into something.
I thought the way that you laid it out earlier was kind of right on. I want to spend a ton of time in the models that the companies that we invest in build, figuring out the exact assumption. There's just not a lot of data in these companies yet. I think it's a lot of really finger in the wind kind of estimation, but it gives me the playing field. And I think it's more of a tool around alignment. Do you, founder, and me, the investor, actually think about building the business in the same way, or at least close enough where we grounded in some of the facts? So I use it more as a tool to start to understand how the founder thinks about building. It doesn't have to be perfect. I think it gives us an opportunity to push and pull on some of the assumptions and see how we actually work together. But in the background, we're going to build our own kind of thoughts around the market in a business, but having a place to start that conversation.
So do you think that Just based on that, do you think founders should be building their own model?
I don't think it's imperative. I think it definitely helps you walk into a conversation and know what the levers are in your business. I think it's a good exercise. But I invested in companies where there are projections to just
You should sign up for Propeller. There you go. The literally the thought here. Very similar thoughts here, right? And it's tried to say. There's been more lies told in the South where have than word. We certainly see it similarly where it is a tool to understand how founders are thinking of resourcing and spending against investing in their own business over time. And I do think, to what I'm talking about, a high quality, robust model that clearly you've spent time thinking through gives confidence that you actually know the leverage in your own business over time and how those levers will change over time. I think everyone in the room knows that those often the market can be exactly correct. Revenue hopefully it will be 2x what you put in a model, but maybe, if it's done what you put in a model, then the numbers are actually going to give the numbers. But how it all ties together and is, internally coherent, is something that I still moving forward.
Next question would be for Mario and then Nicole. For founders out there that maybe are not, serial founders that are not super well connected, that are maybe what I will been like almost like shy founders about not wanting they don't know what's going to happen. Going through the exercise, how do you kind of coach them?
Yeah, and I think there's two components. One is showing the track record results. And I guess if you're raising a Series A, there are proof points around the success of the business, what has worked. And showing, I think there's a kind of point reading the earlier panel just around what have you done to de-risk the business. And that can be done in two ways. One is go to market, showing sales and kind of proving velocity on go to market. But also for some of these businesses, particularly in the fintech, there are lower build cycles. And so what have you done from a product build perspective or distribution perspective to start to de-risk the business? I think having conversations with a Series A investor around what have you accomplished there. And I guess it comes back to this idea of storytelling and narrative, but what have you done to kind of de-risk this business so that there is alignment and expectations setting going forward around where the business is today, but also where hopefully you and the investor of your choice want the business to go in the future. And as both numerical in terms of projections and kind of where anything ultimately kind of end the year in 12 months or 18 months, but also kind of back to what have you accomplished today and how do you articulate that?
So when you say de-risk, some examples.
I think for some fintech businesses which require licensing, what have you done to secure those licenses for from a partnership perspective, if you're selling B2B2C, maybe you've landed some amazing middle B customers, but that C has something which are getting some huge volume of revenue. What have you done to kind of prove out things, made it an associated step so that it is in a position to scale post Series A, articulating that ways I think show pragmatism aren't overly inflated, but also show that you have really some insights into the business and kind of understand the direction where you want to go.
That's interesting. So even for maybe the founders that aren't comfortable, somewhere inside of them, I think this thing. So looking forward.
Yeah, I'm kind of pretty similar idea. You started a company for a reason. You have a vision and a perspective. I think putting it into some sort of plan is, that's really what the model is your perspective on what's going to happen in business. So, I don't think any investor is going to expect you to get it exactly right. Frankly, a bit of flexibility in how you think about the plan. This market is changing so fast. And I think the founders that I've seen really do well are the ones that have a strong perspective, but are able to take in all of the data points that are shown up as they go along and yes. So it's actually that maybe lack of ego or a humble approach is really attractive to me as an investor because we're listening to $3 million businesses. You don't know, but we want to feel good that you have a perspective and vision, and I think that just manifests itself in fun.
For a founder, kind of a dangerous place to go, which is being comfortable with the unknown, right? So you're right. $2 million ARR, you don't really know your full goal with, right?
Yeah. Right. But you've got ideas.
Yeah.
And there's going to be a million things that you're going to test. So it's how you prioritize testing some of those go-to-market approaches, double down where it works, and continue your
Awesome. Thank you. Okay, next question will be for Eugene and Mario. Is that the mic wants to?
Mariam and Mario.
My kids are really hard. Let's see. Good. Let's talk about profitability, path to break even. Do we care about it? How much do we care? How do you feel about that? Is that part of like, is that important to you?
This is very business dependent on how capital efficient the business is and the type of business the founder wants to build and depending on each time. We're working on that, the capital that is available for that founder to invest in that business. At the Series A stage, we generally suggest that there is a view into the dance moves that you could do to get to profitability within 2 rounds. So not in the Series B, but sometime for the Series C. And I'm talking more specifically about a traditional SaaS business where revenues are predictable and manage the business in a more predictable way. We have a diverse portfolio in Construct when it comes to business model and types of businesses. So obviously for deeper tech businesses, this just doesn't make sense, but it is important to be default alive at some point in time. And I think there is a view, and I agree, is that being able to control your own destiny is incredibly value accretive to not only founders but the business itself. And crafting on the plan there, an eventual plan there is a good exercise.
I'm kind of curious, like, as the CFO, for these companies, like, I'm not to, we have to imagine a future maybe without them. You know what I mean? So maybe there's like this like bad scenario where we curtail growth, revenue growth. I just think no venture fund wants to hear that. But in the interest of staying alive, right? So are you ever, is there ever a conflict there, I guess, with the founder?
I don't know if there's a conflict there. There should be an open discussion, and once you get around the capital availability for the business, right? Because different businesses do different access to different dollar markets, and that is just a reality here.
Yeah, and I feel like you find that when they show up with a fully funded model, so to speak, like that, it does lead to towards a strategic conversation, or
It does, and as Nicole was saying earlier, we certainly don't spend that much time in the model either. It just makes it easier to check the box when there aren't obvious errors involved. And when there are, they go, oh, maybe that's something we need to dig into more. And that kind of might spiral.
Yeah, I agree. I think when you have a good model, a good perspective, for me, it kind of comes back to the perspective. This is what I was saying before, is just if you should have a view of what you think your business is going to look like a year, 2 years, 3 years out, what it could be longer term. That I think is important. If you show up in an investor meeting and say, here are all the great things we do today, but I have no idea, that's not gonna give us a lot of confidence in just being vision. But I think you have to be humble when you show up with your model. I think a bigger red flag to me is if you come and say, I'm dusted, have all my assumptions, this is how it's going to play out, and there's no vulnerability there. Inevitably, it's not going to happen that way. So if we can't start to have that conversation early on, it gets me concerned about what the relationship is going to be longer term as the market changes and some of the business change. Like, having strong conviction, but having, loosely held, I think is one of the most important things.
Add on to that, though, I do think there's also such a thing as a too well done model. Right. That the CFO comes in and presents, and like the CEO is just sitting there and quiet, and like, why are they not building product and selling to customers? Like, they're spending all this time like doing business internally versus actually working on the company. So that's actually another red flag that I'm not sure if it's too very or not. But
I do. I would also say is like, if you're kind of raising a Series A, like lean in on your seed investors or private investors for help and guidance. Like, have them check it, review it. Don't have them build it, but like certainly they should be the ones who give you guidance on how to use it.
Yeah, versus like a model. A model to me is like, deep in here are all my 50 assumptions. Like, that's less important than having a plan.
And while I do disagree with not having a perfect projection, the CFO should never be presenting. So it should always be that way. So our last question, this one is going to be for Eugene and Mario. I don't know. I feel like this is like the holy grail of questions for investors. Is like, what should founders ask for? Should it be like, should they just go for broke, get in a growth, should it be more moderate, conservative? What do you think?
Yeah, I'm in of the mindset where you want to have a margin of safety, but also looking to raise too much could also lead to one, potentially some investors may just end up passing because it's not fit for the round. And so if you are raising a $25 million Series A, there's certain Series A investors that just isn't a fit for. And so I think part of it is kind of understanding your audience and your ability to raise based on kind of audience you're going after. But I also love the philosophy where you want to have some constraints because you want to have a North Star to chase for, but still feel like you have enough rope where like you have a margin of safety, you're going to be okay. You're not worrying about, maybe payroll. But we're looking for like a well-funded plan with a margin of safety. And I think that kind of gives a line with investors, but also founders to make sure like they're just not making 50 hires that maybe not be really needed for the business today. But it has to be a little bit more pragmatic around how they think about resource planning and budget.
Gotcha. Interesting. So I didn't feel about, I certainly would use that. If you could say that it is too much, it's one big bank account, which is obviously not great for value creation and all that kind of stuff. So, do you ever think like, well, you could be asking for this, you are asking for this, but really, you probably, it was be better for everyone to get half as much.
I think that's right. I also think that in some ways it's hard to spend money prudent. Like hiring takes a long time. You're not going to be able to hire 10 awesome sales leaders day one. Like, it takes time to train them, get them ramping, but also you want to stagger some of these things to make sure like they're learning through that process as well. And so these plans end up to inevitably being a little bit more of a resource planning over time and not just over day one. And so you're likely not going to need to raise $50 million today. Maybe through the next collective few years, you may need to, but at least today, start with the amount of capital that, again, gives you a margin of safety, but also has a liability around being prudent with investors and it's.
What I come back to is internal coherence in the plan. There are some companies that just need to raise a whole loads of money. And there are some companies that can be great companies that are very, very capital efficient. And when things go off the rail, it's when one type of company thinks so the other type of company and the other type of company thinks that they're the other type. Because it shows some misunderstanding of the market that they exist in, the capital availability that's available to them, for what leads to a difficult working relationship and not generally not enough dollars. I don't think there's a clear answer here in that if you need a lot of capital and the other end of the rainbow is worth that capital, then you should go out with conviction of live that business. And if you don't want to build that business, you should not go out to do that business. And just being honest with yourself, with stakeholders, and it's determined why.
It's awesome. Thank you. Like I said, when I said the formal part, I don't know if there's like a.
Yeah, I'll